Is dollar cost averaging worse than lump sum investing? Well, if I had $1 for every time I got asked a question which looked something like this, then I'd be a much wealthier man than I am today. This example in particular came from Elliot, who commented this on one of my videos in just the last week, and it shares a lot of characteristics to others that I've had over the last 6 months. They normally have a decent amount of money at stake, a long-term time horizon, a reference to maybe the market's being quite high at the moment, and then the good old age question of, should I dollar cost average it, or should I YOLO it and lump sum invest? Well, Elliot and others who have asked me these same sorts of questions, I can't give you financial advice because I don't happen to be a financial advisor, but I can give you guidance which the FCA classes as helping you narrow down your choices, but ultimately the decision is completely down to you. To help wrap up, I will even share what I do so I'm as transparent as possible. So without wasting any more time, let me quickly thank my newest patron Sean and jump into the video. Let's quickly get on the same page about the difference between dollar cost averaging and lump sum investing. Let's say at the start of 2022, Andrew has £1,000 and decided to lump sum invest this into his fund of choice. Let's say the S&P 500. And Andrew quite literally lumps the whole of his investment into the markets straight away. But on the other hand, you have Brenda, who wants to take things a little bit more slowly than Andrew and decides to dollar cost average her money into the markets. But like Andrew, she still fancies a look at the S&P 500. Let's say she decides to dollar cost average this money across a 10-month period, but is a little bit torn between does she invest £25 4 times a month, or does she just invest £100 at a time, just once per month? It's important to highlight that both of these options for Brenda are dollar cost averaging, as the amount of money she's putting into the market is the same and the time period is also going to stay consistent. So the question is, whichever way Brenda decides to go, is she likely to beat Andrew's returns, even though they're both investing into the S&P 500? Well, there's been mountains of research on this, and as most of you know, lump sum investing has consistently been shown to beat dollar cost averaging most of the time. Here's an article from Vanguard who show that lump sum investing beats dollar cost averaging nearly 2/3 of the time. Here's another from a study from Ohio's Wright State University showing again a preference to lump sum investing, which outperforms around about 2/3 of the time. And then finally, for one of my favourite websites called Of Dollars and Data, they published an article finding that lump sum investing outperforms dollar cost averaging between 56 to 81% of the time, depending on the asset class. So there you have it. Dollar cost averaging is worse than lump sum investing, well, on balance of probabilities anyway. As they say, time in the market beats time in the market. But let's be real for a second. You already knew this, didn't you? So the question is, why are we still asking this question? And this is where we start to get into the juicy bit of the video. Even though we know that lump sum investing is, on balance, the better strategy, we just can't seem to pull the trigger in all situations. And that's the right way to be, as lump sum investing does carry some risks, both financial and psychological. Let's take a look at these barriers to get a feel in what situations you might favour dollar cost averaging over lump sum investing. The first is very much a psychological one, as it's when you believe the market is overvalued. You've just got a terrible feeling in your gut that the market at any time now could do a backflip and plummet. Well, the evidence would show that you'd be wrong about 2/3 of the time, but if you feel this 1 in 3 event could unsettle you enough to consider selling, then maybe dollar cost averaging would be a safer bet for you. After all, what's the point in investing if it's just going to cause you significant stress, and as a result, you might bail on your investment even though you're in for it in the long term. The next factor, which I think is the most underrated, is your experience in the markets. Have you ever experienced a significant market downturn before? If you haven't, then the analogy I'd probably use is, no one knows how they're going to react when, say, somebody pulls a gun on you or somebody breaks into your house, for example. You can discuss this situation in infinite detail in a calm, rational way, but no one truly knows how they're going to react in the heat of the moment. Well, the same goes when the market is going through a correction or a significant downturn. You might swear on your life, and even your grandmother's, that you would never sell when the market drops by 40%. But in reality, many people do. So if you've gone untested in the market so far, does lumping all your money into the markets all at once sound like the best plan? Maybe not. It might be best to reduce your risk by slowly putting the money into the market, so if it does happen, it's not as stressful as it could be. But it's not all about experience, it's all about relativity. How big is the sum of money you have to invest? £1,000 could be everything to somebody who is starting out, but then £1,000 could be pocket change to somebody else. Both will feel extremely different about the situation. Think about it. Would you sweat over investing 50p? Probably not. But would you sweat over investing £1 million? Most likely, yes. The larger the amount of money you have to invest versus the amount you already have invested, the more you might lean to dollar cost averaging over lump sum investing. The last key factor is volatility. Is your asset class of choice extremely volatile? Let's look at cryptocurrency, for example. It would make more sense to dollar cost average here, as the stakes are far, far higher as the market moves rapidly up and down. But then you might feel differently about the broad equity markets, which only seem to have a large correction every 8 to 12 years. So based on these factors, let's go back to Elliot's question and start to dice up which parts seem relevant and which parts don't. So the first thing that stands out to me is that Elliot has inherited a good chunk of money to the total of £38,000. It's actually not possible for us to know if that is a loss of money to Elliot or not, but on balance, if he's 18, it's likely to be a good chunk. But then again, we can't assume. Next, it's interesting that he notes that the markets are overpriced and that a correction is coming. This highlights to me that he's feeling quite anxious where the markets are right now. Honest answer to this is that nobody knows what the stock market is going to do. If we definitely knew that there would be a correction coming, then you wouldn't put any money into the markets at all, would you? These are the two bits that stood out to me the most. But in reality, you're never going to know what the right decision to make is. 2/3 of the time, you'll be better off lump sum investing, and then 1/3 of the time, you'll be better off dollar cost averaging. Personally, the worst outcome to me would be to panic sell after a market correction. Where you might think we're in the market or might not be in the market is actually completely irrelevant. It's been proven time and time again that timing the market just can't be done. So sadly, Elliot, it's up to you. Good luck with whichever route you decide to take. But let me be transparent on what I do for a second. If I'm completely honest, I have done a fairly good job of confusing dollar cost averaging and lump sum investing. The reason why I and most others do is that lump sum investing can look extremely similar to dollar cost averaging in certain situations. In my example with Andrew and Brenda, I clarified that they both started with £1,000. But in fairness, a lot of the time this doesn't happen. For the majority of us, it all starts with our monthly paycheck from work. Putting the same amount of money from your paycheck into the markets every single month actually isn't dollar cost averaging, it's lump sum investing. As soon as your money is landing in your hands, it's jumping straight into the market. And for the most part, that's what I do. But on top of this, if I happen to get any bonuses from work, as soon as the money lands, then it goes into my investment account. So at heart, I'm actually really lump sum investing, not dollar cost averaging. For me, I have confidence in lump sum investing as I know it works the majority of the time, and any money that I get from my paycheck, all that I get as a bonus, isn't that big compared to how much money I already have in the markets. But if I was in a situation where I all of a sudden came into a lot of money compared to my investments, so say I suddenly had £100,000 to invest versus my current investments of say £60,000, I've got to say I would think long and hard about investing it all at once into the markets. But hey, I've not got the money, so I've not got the problem. Anyway, that's just me. That's all for this video. See you in the next one.